Is the Fed finally going to get what they wanted all along? Well, it's certainly starting to look that way. Now, in this video, we're going to talk a little bit about why it's taken so long and where we might go from here. Now, in order to understand how we got here, we have to actually go back in time a little bit. And I've got about 4 pages of notes here. So this is going to take a little bit of time. Once you go put some gym clothes on, jump on your treadmill or your Peloton, go for a walk, and just sort of listen to this timeline of events over the last 3 years. And I think you'll better understand why the economy has been so resilient. Now, I'm not saying it will continue to be so, but certainly so far, it has hung in there really well considering what the Fed has done. So first, just to recap. So it's been about 18 months since the Fed started their rate hiking cycle. They took interest rates from 0.25% to way over 5%, which that's about one of the fastest rates of change in history. And sometimes it's not just really what the rate is, it's the rate of change. It's the shock of, wow, that happened really fast. You know, if you think of home buyers in late 2022, when we went from a 3% rate up to 6 and then to 7, as we hit that last 6 to 7, it was like, whoa, what is going on? And then 3-4 months later, boom, everyone's back to action because it became more normal. So the rate of change was very significant. But if we kind of go back for 18 months, we have a stock market that's been surprisingly resilient. We have housing that didn't crash. We've had unemployment staying at near all-time lows, jobless claims that continue to be stronger and stronger as you go week over week. And of course, GDP keeps increasing. Today was a 4.9% GDP reading. So clearly the economy is not stalling. There's a lot of arguments to why. We're going to talk about some of them, which are really just balance sheet driven, and it is past stimulus effects. And then, of course, we also have some other big government spending initiatives that are really propelling growth. Now, I have many people ask me, why exactly does the Fed increasing interest rates, why should that have a negative impact on the economy? And that's a great question. It is, and I think if you look back in history, we would say that as the Fed increases interest rates, they increase the cost of borrowing across the spectrum. So think businesses and consumers. So credit cards get more expensive, installment loans, auto loans, mortgages. So the consumer is going to pull back and not spend. When they don't spend, then businesses wind up having less revenue. Less revenue ultimately leads to possibly job layoffs. Job layoffs leads to less income, which leads to less buying. And it's kind of a washout effect. Now, on the business side, it makes business investment more expensive. So if you were thinking of growing your business or you needed a credit line to get between now and the beginning of the other cycle, you might go and borrow money. But if that cost of money is more expensive, or if that credit is harder to obtain, well, then you won't invest in your business or you lay off people, which then that spiral starts all over again. So in a typical economy, Fed raising rates will slow a lot of things down. And it takes time, though. And that's why they say that there are lag effects to Fed policy. They increase rates today, and you might not feel it for 12 or 18 months. Well, guess what? We're about 18 months. And we're starting to finally see some cracks, which might mean that the Fed is closer to the end. But we've also been saying that for 6 to 9 months. But let's dig into exactly why things have been taking longer. So when I started thinking about this, I wrote down, if you're not impacted, you won't change, right? If it doesn't hurt you, then you're just going to keep going like there's no problem. So when the Fed raises rates to make it more expensive to borrow, I actually had an 80-year-old woman I did a loan for, and she was like, John, I've never had a loan before, but loans are for people that need to borrow money. And I'm not used to this credit thing. She didn't have a credit score, so she actually had a hard time getting a loan. So when you think of that concept, she didn't need to borrow money. So because she didn't need to borrow money, she didn't care. If she needed to buy a car, she bought a car, she paid cash. If she needed to go out that night, go to dinner, movies, whatever, right? Social spending, all that stuff, you put that together, she didn't care. And because she didn't care, she didn't change. She just kept living the way she was living. So keep that concept kind of going forward through everything that we're going to discuss right now. Now, the other thing I want to say is that as I go into this conversation, I know there are going to be many people that'll say, John, you're wrong, because people are being impacted. And I totally get it. I know inflation is absolutely hurting families and many people out there. It's making auto loans more expensive. It is making food more expensive, utility bills. Like, I get that. But this conversation is about why hasn't the economy slowed the way many thought? And it's because the haves have a lot right now. And the haves are not borrowing a lot of money. They're just spending what they're earning. And they actually have more household cash flow than I think we've ever really seen. But how did they get to that point? So I want you to go back to 2020, the early days of the lockdown. And let's just assume Fed officials around the world are saying, hey, there's this pandemic. We're going to have to shut everything down. So if you shut everything down, we're like, oh crap, the economy is going to just fall apart. If all these people stop spending money, there's going to be massive job loss. That massive job loss is going to lead to foreclosures. The foreclosures are going to lead to what we dealt with in the great financial crisis. And then the stock market's going to crash and all the baby boomer wealth is going to just evaporate. And then, of course, they're all retiring. That's going to be a stress on public services. Like, oh man, this is crazy. So what do we do to prevent Armageddon if we're going to push this initiative to lock everybody in their house? So let me just run down all this. I had to take notes because it's so much. So we had PPP, Payroll Protection Program. And that was interesting in that they told businesses, hey, we're going to give you, however, I forget what the calculation is, but we're going to give you a lot of money. And if you use 3/4 of that money to retain your employees, you can use the other 25% for whatever operating capital, then it will be completely forgiven. Forgiven. Here, business, take this money and it will be forgiven if you retain your employees. So then they said, well, what about the great financial crisis? Foreclosures really sort of ruined household wealth, and it took many years to recover from that. All right, well, let's just make it so that people don't need to make their mortgage payment, right? That was part of the CARES Act. So you could avoid paying your mortgage for 6 to 12 months. And just think of a $2,000 mortgage payment. That's an instant $12,000 to $24,000 of cash that you're just giving these families. Then we had helicopter money, right? That was just the free. It wasn't much, but $1,500, $2,000, whatever those numbers were. I think we did it twice. Then there were child tax credits. I think at one point $300-400 per child per month or something like that. So then we said, well, what if people do lose their jobs? Well, then we've got to layer up and actually make those unemployment benefits much more rich so that people are protected. Many people went from making money to going on unemployment and making more on unemployment than that they were making in their job with all the benefits. So then you actually had lower income consumers getting a whole bunch of money, and that lasted for a long time. So during that process, the Fed also came out and said, you know what, let's do also what we did in the financial crisis, and let's buy all these mortgages and all these treasury bonds, right? Let's keep rates really low. So they essentially, and this is just every economic cycle, as interest rates drop, businesses and consumers, households, they refinance debt. And the mortgage is the easiest one to think of, is if you had a $3,000 mortgage, you'd refinance to $2,600. And after maybe a year of that, saving $400 a month, you get your personal financials in good order. That $400 maybe gets replaced with you buying a car or going on vacations, buying clothes, whatever, and the economy starts healing again. So that is the other side. That's rates dropping to stimulate the economy versus right now, it's raising rates to kind of squash it. So then we're going to allow everyone to refinance and not just save like a little bit of money, but like slash their mortgage payment by 30-40%. Right? I had people that had $4,000 mortgages that went down to $2,800. So big, massive improvements, which was awesome. So if you own a home, it was fantastic. But what about the people that didn't own a home? So renters. Well, they said, well, if you don't pay your rent, you can't get evicted. So they would have eviction moratoriums that were all over the country. And then, of course, your landlord could be protected because they might also sign up for the CARES Act, not have to pay their mortgage, but they could also get an SBA loan to get the money back from what the tenant should have been paying. So just stopgaps everywhere. Now, while we're on the topic of low bonds and low rates, you also had the ability for almost every major business out there to refinance all of their debt. And they took really long-term debt, 5, 10. I think Apple even had a 30-year bond. I think the country of Australia took like a 100-year bond at really low rates. So they raised a bunch of really cheap money to kind of shore up their balance sheets. So student loans, let's not forget about that. Probably the biggest scam of them all. Congratulations for all you people that had student loans that didn't have to pay for 3.5 years, but quite senseless and lasted way too long. That just started, but that was another just instant boost to whoever had debt. Now, the reason they did that was student loan defaults and late payments, they actually would crush credit scores. That would make other debt much more expensive. So it was kind of a, hey, let's give you a safety net, sort of protect the credit scoring system. And a lot of people were, with that, able to take on even more debt, buy more houses. So there's ripple effects of that student loan decision that I'm sure will come out over time. We're not done yet, by the way. There's a lot here. Then there was what they called the ERC, the Employee Retention Credit. And that kind of got lost in all the stimulus stuff. And actually it became so popular that some people, law firms, would go ahead and hire dialers in like the Philippines to call all these businesses to say, hey, you're eligible for $26,000 per employee that I think you had maybe at the end of 2019 that you retained through. A lot of those tax credits started going back into businesses in late 22 and early 23. So, and I still think that was one of the bigger scams that were out there. When I say scam, it was just a lot of people were taking this money that may not have met the rules. And there were a lot of other people that became salespeople that earned commissions to then sell the credit. So I expect there to be some audit risk in the future for a lot of people on this. But it was money that hit companies. Now, coincidentally, right around that time, businesses also wound up giving everyone really big raises. Now, I don't know if they're connected, but that was another big part of this is that inflation and wage inflation, it was hard to find workers, right? You had unemployment benefits that were pretty rich. You had the stock market that really went up. You had the housing market that went up. You had a lot of people that owned houses, didn't have to make mortgage payments. They had more cash. You kind of paint that story of everyone was feeling pretty good. Now, here's probably the most interesting thing about all this is when the government came out with all of these stimulus plans, I think they believed that they were going to shut down the economy. It was going to be business as usual. And then they're going to turn the economy back on. And that money was going to fill that gap, that void. But what happened is that, Warren Buffett said once, he said, never bet against the US economy. And the reason is because we find ways to innovate and survive. So just as COVID started happening, everyone just leaned in and figured out how to deal, right? Restaurants started doing a lot of curbside and hey, just drive by, I'll bring it to your car. You had the Zoom, so everyone started working from home. So you had businesses that figured out how to transact. You had the consumer that then reallocated how they spent and maybe where they went. So if they used to take week vacations and jump on a plane, well, maybe they would drive somewhere to the mountains. That stimulated sort of an Airbnb or a short-term rental movement, right? People buying houses and then fully furnishing them because people could travel freely. So, US innovated the job industries where revenue continued to stay really high at a time that they were able to lock in really long-term debt very cheaply and get free forgivable government money. So back to that earlier comment where I said, you're not going to change unless it hurts you. Well, there are a lot of people that aren't being hurt. A lot of companies that just don't need to borrow money yet, right? If they took a 5-year loan back in 2021 when rates were really low, that loan doesn't mature to 2026. So if I'm them, you're like, I don't care. Raise rates all you want. I don't need to borrow money. It doesn't hurt me. So eventually, though, consumers start running dry, right? That money only lasts but so long. And I think that's where we're starting to tiptoe. We're starting to see, for instance, autos. I need a new car. I'm driving, I don't know how old it is. I think it's 10 or 11 years old. It's got 150,000 miles. I hate it. I hated it since the day I bought it. The locks don't work. I have to manually lock all the locks. But guess what? I'm not buying a car because I feel like they're too expensive. Rates are too high. And I also want to conserve some cash right now because I'm in an industry that probably is going to struggle for another 12, 18, 24 months. So a scarcity mindset keeps me from not spending. Imagine that in many other households, people stretching out what they have, not buying more clothes because they bought a bunch of clothes in 21 and 22, maybe not going on that nicer vacation, maybe holding off buying vehicles, right? All those things that then lead into the economy. I actually had someone that owns a trucking company say they actually needed a couple new trucks, but instead of spending $300,000-$400,000 on these big trailers, they said they were just going to fix the ones they had. So just think about that as just one little instance. They didn't want to borrow money to buy the new truck because the truck's too expensive and so is the money. So they're just going to fix what they have and try to stretch out the life of what they have. So everyone that makes parts for that truck and all the delivery people that drive all the parts around to be delivered, the salespeople that represent those companies, all of that whole supply chain is going to be impacted by something as simple as that if it gains steam and a lot of other people do it. So it's really interesting how all this stuff is connected. Now, as all those industries start selling less goods and services, what do? They start laying people off and the cycle starts beginning. So that's kind of my intro into eventually things begin to turn. You know, when I think of things that we're seeing right now, I'm just going to sort of figure out, I've got a whole bunch here. So one is that high interest rates ultimately lead to cash making money. The cash becomes a real investment. You know, if you knew you could just park money in a money market account and get 5 point something percent, that maybe at first doesn't look attractive, but when you hit that point where things feel uneasy, and I want you to think about, so here we are kind of mid to late October and the stock market is now down. I think the NASDAQ's down 10%. In a very quick, bam, it happened very fast. That person might then say, you know what, let me lock in my gains. I'm just going to park some money in a money market. 5% sounds really good right now with the risks that face us. And those risks might be war, right? All the geopolitical crazy that you see, the stock market dropping, all of that making you go into safety, a safety mindset, safety, scarcity, guaranteed returns mindset. So when that happens, also know the stock sell-off can be exaggerated. So if you look at the history of the S&P, I actually put one on my Instagram story. I should kind of put that in here if I can, but it shows right around now at the end of October that this is traditionally when stocks just bam, go up. So I'm curious, does this sell-off continue and gain steam because people move money into these money markets? Or does this just play out like every other year and stocks rebound and maybe this is a Q1 2024 story? Now, the other thing that happens is your cash sitting at your, let's say, Bank of America, Chase, whatever, a lot of people then start moving that into money market funds. Maybe they buy US treasuries or something like that, right? Guaranteed money. Instead of getting paid point nothing from your bank, I'm going to go buy a US treasury and get 5%. So the more that happens, the more stress that puts on the banking sector. When they lose money, they have less money to lend. So therefore, they start reducing lending. They make loans that they give even harder. And that's actually why that SVB and Signature Bank, a lot of them started to fail. Part of that was because high rates wound up leading to them being underwater on a lot of the bonds that they owned, but it was also people pulling money out of the bank. So I want you to think of bank runs. It's not always like, hey, I'm pulling the money out of you, bank, because I think you made bad loans and you're about to die. It's just, hey, I'm going to pull it out because you're not paying me a return. I'm actually going to go over here and get my return. Now, those banks have options. They can say, whoa, before you take that money out and go over there, leave it here, let me pay you more. Now, that increased payment, again, their cost of funds goes up. That means they raise rates on everything else. They get a little bit more restrictive on their loans. That local business that might need some money to get to the other side, the bank might not give them that loan, or they might make the rates so high that the business is like, I'll just lay off some people, right? So all part of a cycle. So as lending gets restricted, businesses can't borrow. Now, at the same time, we have big ticket purchases. We talked a little bit about this with my car story, where people just stop buying because the payment is too expensive. And, we can already see in the Manheim Auto Index, we can actually see that the price is kind of rolling over right now. I'm hearing more and more stress with new car dealers where they're being forced to drop price because supply chain has been fixed and there's not enough buyers, right? Supply demand. Tesla is a prime example of that. I mean, remember in 2021, I think Musk said it's an appreciating asset at Tesla because they keep going up in value. And then I think they've dropped prices like 30% or something like that. Part of that is due to supply chain getting fixed and them having bloated inventory. Part of that is because they want to crush the other companies that are trying to get into EVs. They just have such a big advantage. But the other part is, I think Musk is pretty smart, and he's been saying this at least on Twitter for a while now, which is when rates are high, people can't afford the product and therefore they can't buy it. So what gives? You have to drop your price, right? If your supply is up. That's actually a housing thing we'll talk about. So preservation mindset, we already talked about, right? I'm going to hold off on buying X because I think it might get cheaper, or that I need more cash to ride out something if something happens. Now, the other big thing is layoffs. Now, we have read about layoffs. I actually did a survey with my past clients about layoffs, and what I found was there weren't many. In my DMV, DC, Maryland, Virginia, I said, hey, have you heard of layoffs? The answer was yes, a resounding yes, 100% across the board. Has your company laid anyone off? It was almost zero. Have your any layoffs within your family? Almost a zero. Any layoffs within your family's companies? It was a mixed bag. But back to that thing, if it doesn't hurt you, you don't change. If it doesn't impact someone you know, you don't change. It's when Aunt Susie loses her job, or your cousin, or your best friend's spouse. All of a sudden you're like, whoa, that actually happened in my backyard. This is actually a thing. And once that becomes a thing, the scarcity mindset starts, the preservation mindset takes over. People stop spending, right? It's all part of the cycle. Now, another thing will just be stress in consumer debt areas, right? And layoffs actually will just exaggerate this, but then you have layoffs with depreciation that sometimes is more. So as an example, we're starting to see significant or severe delinquency rates in autos actually exceed the great financial crisis, which should be concerning. And I think part of that is because a lot of people that bought these cars in 21 and 22 when supply chain was kind of jacked up, they paid a big premium. And then you sort of mix the cost of everything else going up and there being a little bit of strain and the value of that car being so much lower, it's easy to just throw the keys on the counter. Now, if you go back to financial crisis, there was a difference because back then you would throw your house keys on the counter, not your car. Everyone, really, the car was the prized possession back then because you needed it to work and make money. Well, today, your mortgage, that low mortgage payment, is actually the prized possessions. Let the car go. You can work from home, get a job coding or Zooming or whatever, right? So, but we're also seeing record amounts of credit card debt. We're starting to see revolving credit default rates also rise. So again, this is all part of the process and it's all starting to happen. So student loan payments are beginning. We talked a little bit about that earlier. I personally haven't seen many people severely impacted by that, but my area, a lot of people have student loan payments that can be $500 to $1,500 a month. And the fact that they had $12,000 to $18,000 per year of free cash flow to spend and do whatever, they did stuff with that, right? They maybe took little vacations, they bought a little something, whatever. That is now reversing. So that we are sucking money out of the economy. I think that's probably going to hurt some larger markets where incomes are a little higher and where the student loan base is larger, the balances are larger. DC might be one of those areas and surrounding areas. Now, next is a big one that I'm actually personally connected to, and that's just the housing transactions stalling. So when a lot of people think of high interest rates in housing, they actually think that high interest rates will make it more expensive. It will crush demand. Because there's no demand, housing prices will fall. So I'm not going to buy because housing prices are going to fall because no one can buy the house. Now, what's actually happened is because of all that other stuff I told you, where people, their personal balance sheets are looking pretty good, they got big raises, the demand has been crushed for sure. But let's say it went from 100 people looking for a house to like 40. The problem is if in a normal market we had 80 houses for sale, we now have 20. So buyers are still outweighing sellers, and that is keeping prices supportive. But the real impact of this cycle with housing is the lack of transaction volume. So when I want you to think about selling a house and then buying a house. So when you sell a house, you get it ready for sale. So you might buy new carpet, lights, paint, right? There's work to be done. Then you go out and you have to pack up your house to move. So you buy boxes and supplies and tape. Then you have to move. So you might hire movers. And then you go to your new house, and then you also usually do some things to that new house. You might buy some new furniture. Well, if you just bought new furniture, well, there was a trucking company that had to deliver that furniture and someone that had to make that furniture, right? And that whole chain of events of people, and then electricians and plumbers and little contractors, like all that stuff has just stopped. Mortgage, real estate, home inspectors, appraisers. So everything that keeps the housing market supported and moving, that has ripple effects for the rest of the economy. So when you just completely crush transaction volume, you indirectly start really impacting the economy. That is now starting to show. So to kind of go back, right, we have higher interest rates, doesn't affect a lot of people because they don't need money, but then it does indirectly start impacting either psychology or the ripple effects of industries that support everything. Banks get a little tighter, businesses then get a little tighter, the stocks start crashing a little, people then pull back and get withdrawn. That withdrawal then gets infectious. A layoff happens close in your circle. You then even get a little bit more tighter with your family budget. And then things start happening. Layoffs might even go up even more. Stocks might even crash even more, right? So everything then gets exaggerated to the point where we have to figure out what happens next. So now another thing I could see happening, and I think I've experienced this clearly during the financial crisis, but also in late 2018, which is sentiment turning as a result of the media talking about price declines. For instance, right now, there are plenty of areas around the country where prices are down double-digit percentages, right? Austin's probably the easiest one to talk about. But know that, one, there's a reason for that. It could be oversupply, excessive short-term rentals. It could be an area that maybe thrived in a Zoom world where work from home might be unwinding and everyone's going back to maybe where their businesses were. So it's a lot of things that go into why local areas see housing value stress. But seeing it causes local paralysis, right? I see an article, housing prices down X percent, I'm going to pull back. And then I look at the mortgage payment, I'm like, ooh, that's high. My friend just got laid off, right? You can see how all this starts telling a story of preservation of capital, paralysis, wait till next year. All of that has some ripple effects. Now, a lot of people are wondering, like, when are rates going to actually get better? And, one thing I do want to point out that is, again, very different in this cycle, where I told you about how when rates were really low, businesses were able to refinance and take out long-term debt, right? Apple taking 30-year money at a really low rate. Well, our government is not as smart, as we all know, and they took a lot of short-term debt. So all that stimulus that they had to do, well, they issued treasury bonds, and maybe they were 1 year, 3 year, 5 year debt, but it was excessive 1 year, 3 year, 5 year debt. And all of that is actually set to roll in the next year or two. Now, on top of that, and when I say set to roll, when let's say you're a bond trader and you're like, hey, federal government, here's $100,000, you're going to pay me $1,500, 1.5% for 3 years. And at the end of 3 years, you're going to give me my 100 grand back. Well, if our government doesn't have the 100,000 sitting in the kitty to be like, here, they have to go raise money to pay the bondholder back. Well, they're then going to go raise $100,000 with another bond, and that bond might be $5,000 a year of interest, right? A 5% return. So that is set to hit next year. So there's a lot of debt issuance that Wall Street traders are starting to look at. Not only that, we are running a massive government deficit. So there have been tremendous stimulus. Every time we hit the debt ceiling and then we raise it, at least this calendar year, it's taken like 6 weeks to soak up $1 trillion. I I really wish someone could show me where it's all being spent. It's insane. But issuance, money coming into the system, if you think of supply demand, if there's so much supply coming in and there's not a lot of demand, those people can set the price, right? Just like in a oversupply housing market, the buyer can come in and be like, I know it's listed for 600, but I'll give you 500. And the seller might have to do that. They might have to sell, just like the government needs to raise the money. So that dynamic is also what's keeping interest rates quite a bit higher. And one of the biggest buyers of US Treasuries were banks. But to that issue I told you before, they might not have the money to actually buy all the bonds because they actually have other debt that's tied up in long-term bonds that they bought in 2020 through 2022. They also might have commercial defaults that they're worried about. So there's a whole different conversation about the commercial debt crisis for properties. Think of the value of a commercial property being a percentage of the rents collected. It's not. It kind of in a backwards way is. And then assume that half of the building is now rented and they had to drop prices by 20% to entice people to rent. So the rent revenue is down tremendously for commercial property. So you put all that stuff together, banks might not be a buyer. So the possible outcomes from here, I think, are tricky. If I go back to the last Fed hiking cycle, late 2018, early 2019, I actually went and I read all of the Fed meeting minutes of all of 2018 and into 2019. Eerily similar in the sense where the Fed says soft landing, everything's fine, economy's too hot, we're good, we can take another quarter. We're going to keep doing this quantitative tightening thing, which essentially is when they bought a bunch of bonds, mortgages, when someone refinanced or moved, right, that loan gets paid off. If the Fed owned it, they used to reinvest it. They'd say, oh, well, that guy paid off his $500,000 loan. Let me take that 500 grand and go buy a new mortgage. And that's just kind of what they did. That's the reinvestment. Quantitative tightening is we are no longer going to reinvest that 500,000. So they did all that in 2018 as well, into 2019. And then as cracks formed, the first thing they did is they pulled back their quantitative tightening. And the next step was to lower interest rates. Now in 2019, interest rates went from about 5.25% to 3.5%. Because the lag effects of Fed tightening finally hit. Now, one could argue something similar can happen in 2024, that all of that same stuff's going to happen, only this time it's going to be a bigger punch in the gut, that the economy slows down way faster, way sharper, and there's way more banking stress than we realize. But then if you put all that extra government debt, the debt roll and the deficit spending, does that counteract the softening economy? Well, interest rates just remain stubbornly high for another year and a half. So it kind of leads me to the unknown of the future. I think about a year ago, everyone said we thought interest rates would be in the low 5% right now, right? Rates were in the mid 6s and we were like, oh, inflation's getting under control and inflation's dropping. And as a result, we think rates are going to be lower. The Mortgage Banker Association, I think, had a 4.9% rate target end of 2024. Now I think that's up to 6%, right? So everyone has rebalanced their expectations. And I think part of it is because of deficit spending, government debt roll, inflation being a little stickier, the haves having so much more that they just keep spending and keep living, and they just keep supporting the economy enough to keep inflation hotter than we want it to be. And then you have all the geopolitical stuff and supply chain disruption. Supply chain disruption is not that people aren't working like COVID days. It could just be onshoring or friendshoring leading to an increased cost of production of stuff. So, I think one could argue we went through several decades of offshoring, right? If it took me cost me $100 to make something in the US and I could send it to China and have them make it for 10 and ship it back for 10 more, well, that is cheaper. Then you had the Amazon effect. Amazon came out, drove the cost of everything down. Well, what if we have actually a decade of everything getting a little more expensive? We have supply chain remapping where everything is being built at places that are a little more expensive. But they're a little more expensive because maybe there's a little bit more guarantees behind that trading partner geopolitically, right? So India versus China as an example. So where we go from here, I don't know. As you can see, there's so many variables, so much complexity behind all the past stimulus, all the changes in consumer behaviors and habits. I call 2020 now the great economic and social reset of our recent time, where behaviors and spending patterns have changed and consumer balance sheets and family wealth is just so vastly different that I don't think we can look at past cycles to figure out where this one ends. So time will tell, but I do think the next 6 months will tell us a lot. I am bullish on housing prices in a twisted way, even with rates where they are, because I do think inventory stays really, really low. I'm bullish for my market, DC Metro, where incomes are relatively high, the job market's relatively diverse and stable. And I think as we go through this next leg, I believe the jobs of our local economy are the ones that stick and actually thrive. But inventory is going to stay really, really low. Construction is anemic. Developers are not willing to take a lot of risk. So of course, that's even less inventory to rebuild. And there's definitely a changing of where people want to live, whether it's city or suburbs, for school districts or commuting distance. There's work from home unwinding. I think that's going to be a little bit of something in 2024 and how that impacts the migration patterns of people. But I am curious to get your thoughts. What do you think? And for anyone watching this around the country, not in my market, tell us stories about your market. What are you seeing and what are you feeling? I do believe that this cycle will ultimately show very, very different stories around the country. I don't think there's going to be the entire US did this. I think there's going to be like, you guys did great, you guys fell off the cliff, and then everyone out there is in the middle. And everyone's story is going to be different. Every local economy is different. Every local housing market, how much investor greed they had, how much new construction they still experience, what their population growth has been, right? There's all that stuff that goes into it. Well, until next time, I'm John Downs. I hope you've enjoyed this video. And again, please let me know your thoughts. Always curious to see where you think this goes.